All right, good evening, everyone. Welcome to our homebuyer workshop, our masterclass with our alumni partners with the Association of Former Students with Texas A&M. Great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to be a part of tonight's class. So really excited to take you on this path towards homeownership. This is a very interactive class. It's only a 1-hour class, but we'll try to weave in a lot of great content for you. So as I present this to you, we'll share with you just some more ideas and resources around home ownership. My name again is Jason Maida. I work with a company called American Pacific Mortgage, and we're in our second year, or actually third year of partnership with A&M, and it's a really great reciprocal partnership where we get a chance to not only host classes like this, but get a chance to meet one-on-one with fellow alum all across the country to help support them in their journey towards home ownership. So a lot of our relationships with our clients start in a classroom like this, and then you'll learn a little bit more tonight about how to get started and set up your free consultation with us. American Pacific Mortgage is the 9th largest lender in the country. Our team in particular specializes in first-time buyer options for our clients. So when we teach classes like this, we like to spend a lot of time looking at different resources that are there to help you on your goal of achieving home ownership. Our talking points for tonight will include looking at the housing market. That includes talking a little bit about interest rates. We'll do some analysis of renting versus buying and what that looks like for you. We'll also spend some time looking at credit. How can we help improve your credit score to get you maybe to that lesser cost financing option or decrease mortgage insurance, whatever that might be. We'll also look at different programs that are available to you. Some of the terminology that we have in our industry, we'll kind of put it all together with our loan product segment. And then we want to talk a little bit about savings for homeownership. That tends to be one of the biggest challenges for most first-time buyers, is just maybe not having enough funds saved up for homeownership. So we'll go through that as well. And then we'll talk about first-time buyer programs. Depending on what state you're in, there are various first-time buyer resources that are out there in the market to help make homeownership a little bit more of a closer goal for you. Speaking of that, if I know you register for tonight's class, but it'd be great to learn where you guys are joining us from. So if you have a moment, if you want to just drop in the chat, maybe where you're at or maybe where you're thinking about buying, because we'll get to our first-time buyer portion of our class later on, and we can talk about specific state options. We can kind of just do some, idea sharing, if you will, on some different programs. We are going to talk about the TSAHC program, which is the Texas State Affordable Home Program. So if a majority of our group is in Texas, obviously we'll spend a lot of our time looking at that. But if you're in another state, we'd love to learn that more. Okay. And thanks to those that are all already dropped in the chat. So that's really super helpful for me. We're also going to go through the buying process tonight. So what does it look like to go from classwork to actually taking those steps to homeownership? So I'm going to walk you through the milestones, and then finally we'll wrap up with just what does it look like to do a consultation with us and learn more about your goals and budget around homeownership. All right, well, let's dive in right now. Thanks again for sharing kind of where you're thinking about buying. And I wasn't super surprised, but everybody looks like we're looking in the Texas market. So that'll make it super easy for me tonight. So we're going to talk a lot about that later on in class, and I'll take in your questions you have on that Texas State Affordable Program. So when we think about buying, and we really got to think about, does it make sense for me, right? This is a big, big financial decision. It's probably the biggest decision that you've had to make so far. And it's really important to have a partner with you on that journey. And that includes your lending partner as well as the real estate agent that you select in that journey. Now, when we consider homeownership, we want to look at it from a different lens especially than in comparing to what we pay in rent. We have to consider, as a homeowner, I probably have a fixed payment now. It might be higher than I'm paying in rent, but it's fixed. And a lot of our clients that are buying in today's market, while it's a little still elevated interest rates, will probably be looking to refinance later down the road when rates start to kind of normalize a little bit. But you have the ability to create a little bit more stability in your housing expense. Also, and most important, really, this is an asset, right? And this asset should appreciate over time. So depending on what our price to get into the housing market looks like, hopefully that value of home will go up over time. As I continue to pay down my mortgage, as my home goes up in value, I create home equity for myself. And for those of us that are homeowners, that's probably one of our number one assets that we have, let alone from, say, retirement or maybe 401k accounts. So it's a big, big deal for us. Now, there's also tax benefits that exist with homeownership and potential tax deductibility of interest. Even if I decide to make some tax or some energy improvements to my home, I could potentially realize some tax benefits in doing some of those improvements. So I really encourage clients when they're thinking about home ownership, it's really not, a fair comparison to look simply just at renting versus looking at buying and saying, oh, okay, those numbers are the same, because it's really not. Because when we think about home ownership, there's a lot of great attributes that are part of home ownership that we need to really factor into the calculations. And to take you through kind of what that might look like for you, I'm just going to screen share with you one of our calculators that we have available on our website. It's our rent versus buying calculator. It's a really great tool to get a better sense of, like, when I invest into home ownership, what's it going to look like when I factor in the benefits of equity appreciation, tax benefits? When am I going to get to a place where I'm not only breaking even on my investment to now I'm starting to go into the plus side of home ownership? So we've pre-filled an example here on screen for you. I'm going to make a couple adjustments here. Just want to make sure that we got it all set up here correctly. And let me just make sure we got our rent set up here. So give me 1 second, and then we're going to, okay, perfect. So I think we're going to tweak this rent payment just a little bit here, but I would encourage our class, once you're going to get all of our tools from tonight's session back out to you in email. I'm also recording tonight's class, so that'll be up on our YouTube channel. But, I would encourage you to maybe spend some time taking a look at what this scenario or this calculator could look like for you. So in this case, we have someone that's buying a $350,000 home. They're putting 3% down, which basically means we would finance 97% of the sales price in a loan. And then we have a projected start date. This is someone buying a house in June, but that would obviously change depending on when we decide to make that next move. We do have mortgage insurance. With mortgage insurance, that comes into play when we put less than 20% down to purchase our home. So that's when mortgage will, and we're going to explain mortgage insurance a little bit later. I want to pause really quick. I just saw some chatter in the chat. How's audio, guys? Are we okay? Okay, somebody would just let me know I saw one person mention they're having some audio issues. Okay, thanks, David. David says I'm crystal clear. So, all right, cool. Thanks. All right, well, let's kind of continue on. So in this kind of homeownership calculation, we factor in the mortgage insurance, homeowners insurance, which will vary based upon where you're going to buy. If you're going to buy in Corpus Christi versus the DFW area, that could change what homeowners insurance looks like for you. Property taxes, we're going to have to factor those into the calculations. If I'm thinking about buying a condo or a townhouse, that would influence the monthly payment. And then this is what I kind of shared with you, the slide back, which is just the tax benefits of homeownership. Now, depending on what tax bracket you're in, that will change your upside of tax benefits, but we would want to plug in a tax bracket. We have cost of maintaining my home, and I actually would probably even argue we might want to kick that up a little bit. So that's a percentage of your home, the selling cost of my home, how much my home's going to appreciate over time. And obviously different markets appreciate quicker than others. And then our scenario assumes someone that's renting for $2,000 a month, right? And of course, as us being renters today, we know we have renter's insurance costs, and more than likely when we renew the lease of our home, we're probably going to see a jump in the expected amount that our landlord is looking for, right? So our calculator takes into consideration now on the rent side, what you're paying monthly, how much rent's going to go up on an annual basis. And that's on our rental column, right? And then on the buy side, we have someone that's buying a $350,000 home and investing 3% with an assumption that they're going to have a 3% appreciation rate. So basically what the math tells us is that if we factor in those appreciation rates, the tax benefits, we're going to become profitable in home ownership in 4 years with that investment. So when I stack those budgets side by side, that's what it's going to look like. I would generally want us to be 4 years, 3 to 4 years in break-even point in home ownership. The math is going to look a lot better, of course, if we're paying higher rents or we're buying a lesser priced home, but that's how that calculus comes back at. Now, as I mature in my home and I have it longer, then obviously my break even starts getting better. My equity appreciation gets better year over year. And in fact, if I was to look at, 5 years, I'm now up $10,000. If I was to go in and span this out a little bit further, I'm going to be seeing a much better return on my investment. So if you look at this graph here, if I say, okay, I'm going to look at what the difference is in home ownership versus renting 10 years from now, well, now I'm $58,000 ahead, and that changes the ball game for sure. Now, everyone has a different entry to homeownership, and everyone in today's session probably has a different, what we definitely do have a different budget in terms of what you're paying in current rent. So I would encourage you, like I said earlier, take some time, dive into that calculator, really helpful tool. As part of our consultation process, I'm also going to take you through that tool as well, because I think it really helps you to better understand homeownership and maybe where you want to go with your budget. Now, your entry point to homeownership will also be kind of dictated to a certain extent about what the housing market is doing. Now, the Texas housing market is favorable for buyers right now. There's more inventory in the market than most states. In fact, Texas, Florida, Colorado, and Georgia, this data is about 90 days old, but they had the highest level of supply in the country. So that would lend us to believe that there's a little bit more of a buyer's edge in the market. So, sellers are a little bit more apt to negotiate with buyers, and we're seeing not only reductions in price, but we're also seeing sellers that are willing to provide credits towards buyers for what we call closing costs. And we'll talk more about that later. You can see the median price in the Texas market, that is median, so that's across the entire state. You can see number of homes sold is down 5.5%. Some of that can be dictated by economic conditions. 91 days on the market, that's what kind of sticks out as a big one. So you're basically seeing that some homes are staying on the market 3 months. So that's a good sign for buyers. So I think, as I look at all the markets that we serve across the country, Texas is probably one of the most attractive markets for a lot of our first-time buyers, just because of not only the price point, but the negotiation opportunity for most in the market. Now, as we forecast 2026, I know we're halfway through the year right now. There's obviously some things that have come in the picture economically that we didn't expect, like the conflict in the Middle East and how that's kind of influenced interest rates. But all in all, we are assuming 2026 to be a bit of a reset in the housing market. Homes to be slightly more affordable. That could be a function of reduction of price. That can be also lower interest rate environment. Interest rates still aren't off to the start that we expected them to be, and the Middle East conflict has played a kind of a big role in that. But we are starting to see some improvement in the most recent days. Price growth is expected to be modest, and we're not going to expect like big jumps in home values this year. We might even see some dips, especially in some of the over inventory markets. So more markets that have more inventory, or homes that are just staying on the market longer, are probably going to see some reductions in prices, which is good for us as first-time buyers. And then the inventory and supply can improve a little bit. You saw the Texas slide just a second ago. So that can give you more leverage as a buyer to negotiate reductions in price or possibly seller credit. So I do think I get this question asked to me probably once a day, which is now a good time to buy, right? And I think for those of us that are in a financial healthy position, I think there is some opportunities to buy now, because guess what? Everybody wants the lowest rate. They want the lowest priced home, and that's great. But guess what? Everybody else wants that. So guess what? You're going to have a much more competitive market when all those things kind of correlate. Now, as we look closer into the Texas housing market and some of our forecasts, here's what we're seeing going from 25 to 26. Some home price growth here by plus 4%, higher transactions up 3% year over year. Mortgage rates, obviously, this one's kind of be a little bit of a variable that we'll talk about in just a few minutes. The housing starts would be how much new construction we're seeing built. And then single family rent maybe going up slightly. And then, as you've heard me already talk about, it is definitely a buyer-friendly climate for sure. Just to give an example, we've had one of our fellow alum that was purchased a home just a couple weeks ago in Corpus Christi with us, and in that particular situation, that buyer was able to negotiate seller credits. I think we had up to $5,000 in seller credits on somewhere around a $350,000 purchase price, in really favorable conditions and terms for the buyers. So I do think there's really opportunity in today's market. On the interest rate side of things, that is one thing that we're dealing with, as it tends to be quite volatile in the market. It's kind of tied to what's happening in the news right now and the on again, off again peace talks. There is some better signs with where interest rates are going, and we've seen oil prices. I think we're down to like $70 a barrel right now, which is much better than what we had seen, over $100 a barrel. But interest rates remain quite volatile, and average interest rate today is somewhere around the 6.4 to 6.5 level, but it has been certainly a wild ride this year in interest rates. We had some hopes that we could see interest rates slip below 6%, as you can see here, but that's certainly changed with kind of what's been happening around the world. But at the end of the day, I think we do have some signs that interest rates can stabilize, but it's going to be very much be data dependent. We've had a new federal chair come to the helm, and Kevin Warsh, and so we've got some objectives laid out by him, and so we'll see how the Fed kind of moves. There is some concerns that they could ratchet up interest rates, and that obviously would have an effect on what ultimately mortgage interest rates do. But it is really going to be kind of a daily situation and kind of monitoring what's happening in the markets, and that's what we do as one of our value adds for our clients and supporting them on this journey. Now, all interest rates are not the same for everyone in purchasing a home. It does vary based upon a few key factors like credit score and the eligibility for a product, what product you're going to select, how much you decide to finance, what your down payment looks like. You might decide to pay additional funds out of pocket. We call those discount points in order to bring down your interest rate. Or the term of your loan can also influence your interest rate. So if I take a shorter term for my mortgage, that could also lower my interest rate. As I meet with you for a consultation, as one of our next steps, we're going to kind of figure out the right design for you with your home buying plan. Now, credit's a big mover when it comes to cost of financing for all mortgage lenders, whether that's interest rate, type of product, or mortgage insurance. Every loan program has a minimum credit score, and you can see those highlighted here on screen. Now, in lending, we always take the middle credit score of all three agencies that report out. And you guys are familiar with the agencies. That's Equifax, Experian, TransUnion. They will get a middle score, which is basically taking a look at the high score. There's the middle score and the lowest score. So if my middle score is 740, that's what I'm going to be using to determine the eligibility for a product. If my partner is going to be included on the application and my partner scores are 720 as the mid score, then that 720 is a score that we'll use to determine interest rate, mortgage insurance product, so forth. Now, as you look at your credit report, if you've had any challenges in the last 12 to 24 months, that could be, a late payment or higher utilization. It's really going to impact you in the most recent 12 to 24 months from the date of that negative event. And so that's where you'll see the credit score start to get diminished a bit. As we recover from those events, as we go further out over time, then that score will eventually start to recover. There are three different models to credit scoring. There's the credit card model, which, by the way, shows up in a lot of your monitoring tools like Credit Karma. So you might have a little different Credit Karma or credit card score than you will see on the mortgage side. There's auto financing if you're going to buy a car. And then, of course, there's the mortgage model. I'm going to take you through the mortgage model in just a second so you can kind of see some of the areas that can influence that mortgage credit score. This is a matrix to help you better understand how long negative items will stay with you on your credit report. Now, the impact is in the most recent 12 to 24 months, but this is how long that impression will be on your credit report. So if I've done some hard inquiries, they're going to stay there for 2 years or less, but it's going to impact you, especially in that most recent 12 to 24 months. If I had late payments, it'll be on my credit report for 7 years. This is the score calculation on the mortgage side. And I get a lot of clients that reach out and say, hey, Jason, I know I'm at 780 on my Credit Karma score. And then we pull their credit and their score is like 740. And they say, well, why is the difference? And that is attributed to just the different types of risk models that are in a credit card model versus the mortgage model. So let me show you what the mortgage side looks like. My hope is that in class, you would just identify a couple areas of opportunity for yourself to say, hey, I can kind of dial this in on my credit profile. And of course, get some lift out of your credit score. The first area is going to be how long have I had credit? So the longer my credit file has been open and I paid on time, the better my credit score is probably going to be. And then when we look at in use and new credit, we're talking about when we open up new accounts. So we really want to limit how much new accounts we open and the number of hard inquiries that a creditor does on my profile. In our process, when you decide to take the next steps in homeownership, we only start with a soft credit check. And the reason why we choose to do that is because we don't want your score to be impacted while you're trying to figure out homeownership. We want to provide you with some different solutions. And then whenever the time is right, you can start going and getting active in the market. But we don't do a hard inquiry until you're actually under contract with a seller. All right, next kind of part of this wheel is amount I owe, which is credit utilization. And that's probably the biggest area of opportunity for most of our clients that I partner with. It's 30% of the credit score, and we're looking at credit balances versus credit limits. Ideally, you want to try to keep your credit balances below 10% of the credit limit. If you've just made some bigger charges for some trips or big expenditures, if you're now at, let's say, 80% of your credit limit, you really want to try to do your best to get below 50%. Once you've gotten to that level of debt, then we get to 30, and then we get to 10% utilization. So one of the things we always talk about in class is how do you manage down credit utilization? Well, one thing I would encourage you guys to do is to kind of change how you pay your credit cards. So there's a due date on your credit card. There's also a credit activity date or closing date for your bill that ends just before your due date. So what I would share with you guys to do is that try to pay off that credit card or pay it down before the billing cycle or statement activity date closes, because then you get ahead of the reporting out to the credit bureaus. So if your due date is on the 5th, but your closing date is the 20th, try to pay off the credit card or pay it down by the 19th. Then you have a lower balance that gets reported out as your activity for that 30-day cycle. And then that's shared with the credit bureaus. So now you have a lower balance, lower utilization, higher credit score. All right, last section is payment history. That's, of course, how have I paid my bills? If you've had any late payments, they get rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more significant in the late, the bigger impact I'm going to have to my credit score. All right, now as we'll kind of dovetail off of credit into student loans. But before I do that, just want to make sure any questions from our group here. I didn't get a chance to mention that you can drop your questions in the Q&A. I'll kind of monitor what's happening there, and then you can just throw them in the chat, and then I'll definitely answer those on air. All right. And we'll also carve out some time later on in tonight's class. Let's talk about student loans. There isn't a day that goes by that we don't talk about student loans in our consultation sessions. And so I just want to give you some insight as to how we view that from the lender's perspective. And so in lending, if you're on an active repayment plan, whether that's a savings plan, graduated plan, whatever it is, then we can take that payment right away and use that for qualifying. So if you have a $75,000 level of student loan debt and you're paying $250 a month, well, we can use that payment right away. Where it gets a little trickier is that if you're not in repayment, and that's the case for many of our clients, just because of the federal forbearance in loans. Some of those are coming back online, but a lot of them are still in forbearance. So if I have that same $75,000 worth of debt and I'm looking to apply for a Fannie Mae conventional loan, then I have to take 1% of the balance as my monthly payment, which is, $750 a month, which is higher than, say, someone that's on a savings plan. If I'm doing an FHA loan, we take 0.5% or $375 as the monthly payment. And so we run those calculations through for our clients when they do a consultation with us. But I share that with our class because I don't want you to think student loans can get in the way of home ownership, but I think it's also important to understand our calculations as a lender, because that has to be folded into the transaction in qualifying for expenses versus your income. We'll spend some more time talking about that a little bit later in tonight's class. All right, let's talk about loan programs. And the reason why we do qualifications for, say, student loans, as an example, is that because every loan program has guidelines that are attached to it, that are specifications that we have to meet in order to achieve a certain loan product. And so I'm going to give you a high-level look at some of these loan programs. And then, I think a lot of this terminology you've already maybe picked up on in some of your searches prior to tonight's class, but I'll kind of help tie it all together for you. The first loan is a conventional product, which is a Fannie Mae Freddie Mac loan with a minimum down payment of 3% for a first-time buyer. There is a minimum entry point for credit scores. And then every year, Fannie Mae or FHFA sets the maximum loan limit for a conforming loan limit. This year in 26, it's $832,750. I know all of us are going to buy in Texas, so that is your maximum loan amount. But if you were going to buy in Arlington, Virginia, you could go up to a much higher loan amount and stay within the conventional guidelines, but it does require a higher minimum down payment. The FHA loan is a government insured product. It does require you to be a permanent resident to access that product, as well as the USDA product, because those are both government insured products. It's a 3.5% down payment for FHA. And then the maximum loan amount will change depending on where in what county you're going to purchase in. The USDA, as I mentioned, that's also a government insured product, but that is for clients that want to buy in more rural areas. The benefit around that product, it's 100% financing, so there is no down payment. And then the maximum loan amount will change by the location of the property, but you do have to buy in a rural designated area by USDA, and you have to meet income limits for the program. And then the jumbo loan is going to be an option for clients that need to purchase at more elevated price levels and financing support. but does require them to have a minimum down payment of 10 to 15%. So we're looking for situations where we're going to be financing more than $832,750. And then finally, our VA home loan. That's for our veterans that have eligibility for the VA home loan product. The benefit for the veteran is there's a zero down payment option, a lot more flexibility in the underwriting guidelines, lower credit score requirements, just to help encourage our veterans for homeownership and make sure they have the proper support. And then most of the programs that I just went through, well, I shouldn't say most, but all four of these programs will also tie together with first-time buyer programs. And so we'll talk more about that in tonight's assistance segment, but they will be compatible with most first-time buyer programs in Texas. Now, when you put less than 20% down to buy a home on a conventional loan, there's a thing called private mortgage insurance, which essentially pays insurance. It's insurance that you pay as a buyer that protects the lender against maybe default by you as a buyer on that loan. That's on a conventional product. There's also FHA mortgage insurance, which is in play for any FHA loan, regardless of down payment. So let me give you a quick kind of debrief, if you will, of what mortgage insurance looks like for both product segments. On a conventional loan, that mortgage insurance comes into play, again, when I have less than 20% down. It's also tiered in the pricing based upon what my down payment is, how much my credit score is, and how much I decide to finance. The more I can put down, the higher my credit scores, the lesser cost I'm going to have for mortgage insurance. And conventional mortgage insurance does have a cancellation option. So if I put, 5% down and, 5 years from now, my home has gone up in enough value that I can cancel my mortgage insurance, you could do that with a conventional loan and not have to refinance your home. This is what a calculation looks like for mortgage insurance for a conventional loan if someone's putting 3% down with a 740 credit score. So it's about $92 a month, not bad. Alternatively, if we look at the FHA product, that is a government insured product, and it also includes two forms of mortgage insurance. There's upfront mortgage insurance and then monthly mortgage insurance. And different than the conventional loan, we don't have a cancellation option. So the only way we can exit mortgage insurance once our equity appreciation comes up higher is that we have to refinance out of that FHA loan. As I think about designing FHA specific products for clients, that's going to be a situation where we're looking at the FHA as an opportunity to enter home ownership and have a little more flexibility in qualifying, maybe because I have maybe a lower credit score or higher expense ratios, stuff like that. We're going to look at different options for you as a buyer, but FHA would be kind of the secondary option if we can't qualify in a conventional product. And then you can see kind of the expenses here on the FHA mortgage insurance noted here. All right, now we're going to talk a little bit about qualifying income. So I get a lot of questions from our alumni groups that I work with throughout the country about what income qualifies and how can I use this and what does that look like. So I'm going to just share back with you some of those scenarios that I encounter in my day-to-day with clients. And I also want to pass along to you some of the documentation requirements that we use to verify income as part of the home buying process. So here's some of the scenarios that I hear from, or questions I get from a lot of clients. One is, looking at verifying your 2-year history of work. So a lot of times clients, they initially think they have to have a 2-year on the job history. As a lender, we only have to verify a 2-year work history, but that can also include education. So if I just graduated from A&M in the fall and I'm just entering the workforce, we can still qualify for home financing. So to give you an example, we have one of our A&M alum purchased, and they had just finished up grad school just a couple months ago, but they had a job lined up with an offer letter. They were able to secure their financing for their future purchase based upon that offer letter and us being able to tie together their education as well as previous work history to make up that 2 years. So you don't necessarily have to be on the job a certain amount of time. It's a case-by-case scenario, but we just have to verify 2 years of employment and or education background. So that's kind of the baseline for most income eligibility. Now, if you have variable sources like bonuses or commissions, maybe you're in an hourly position and you get overtime. In that case, we generally have to see that you've been doing that job 2 years in order to count that income because it is variable and we have to do a historical, usually 2-year average of that income. If you're self-employed and you're filing as, say, a sole proprietor or a C Corp or a S Corp or whatever the case may be, then we have to show that you've been doing both jobs, or sorry, having that business, I should say, for 2 years. So 2 years of tax filings. Now, if you have dual employment, so you have W-2 employment, plus you also have your own business, then we have to show that you've been doing both jobs simultaneously for the last 2 years. All right. One other thing I'll just kind of share with the group, if some of you are working for maybe a startup company, or just have a plan of RSUs, restricted stock shares, those can be potentially used in our income calculations for the vested shares, and as long as you've been with your employer for at least 2 years. All right. Any questions on income from our class? Okay. All right. Because I do want to kind of just now pivot a little bit, talk about expenses versus income. We call that debt to income ratio, which is essentially analyzing what expenses do I have today, but what do my future expenses look like in home ownership, and then comparing that to your pre-tax income. So the debt to income ratio is a measurement we use for qualifying. Not going to necessarily dictate affordability, but it's going to show us like where do we stand in relation to the guidelines for a specific loan program. So that debt to income ratio takes into consideration my existing debts, credit cards, auto payments, student loans, whatever that might be, along with the principal and interest of my new mortgage, the property taxes of my house, maybe mortgage insurance if I'm putting less than 20% down, and homeowners insurance. And so all those get factored into the monthly budget. And of course, if I'm buying a condominium, maybe a townhouse, then I have HOA expenses. So we take those expenses versus your income, and we've provided you an example of what that calculation looks like here. And what in this example we come up with is a 35.3% debt to income ratio, which tells us that that particular buyer has 35% of their income pre-tax going out to those expenses. And the guidelines allow us to be as high as 45 to 50%. That's the highest we can go for qualifying, which is just a guideline for eligibility. What we're more concerned about is affordability. And that's one of the conversations we're going to have as part of your session with us in the consultations, just to say, hey, what does that $3,000 mortgage payment feel like? Is that reasonable for you, given you're currently paying $1,800 in rent? So I would say as a debt to income ratio analysis goes and looking at what would be recommended, I would say probably if we can keep that debt to income ratio in the 33 to 36% range, that seems to be pretty good for most clients. Everybody has a different kind of a tolerance level, and it really is dictated by what the cost of living looks like for their respective market. All right. Well, as we kind of cross the halfway point almost with our class, I wanted to share with you a little bit about savings for homeownership, but it also includes what we need to save for down payment as well as closing costs to buy my home. And we're going to talk about assistance programs in just a bit. But when we think about what we're going to have to kind of build up in the nest egg, so to speak, it's going to be inclusive of our minimum down payment, which tonight we learned is 3% of our purchase price, but also closing costs to buy our house. And those closing costs are negotiable with the seller, but I always recommend clients to budget about 2 to 3% of their purchase price for those expenses. So when we think about buying, let's say, a $300,000 home, we're doing a conventional loan with 3% down. That's $9,000 on that side of it, plus closing costs, which could be maybe another $6,000 to $9,000. So in that scenario, I probably need somewhere around $15,000 to $18,000 if I'm not utilizing assistance programs. Now, how do we verify those assets that are used in a purchase? Well, here's some of the acceptable sources of down payment. Things like checking and savings accounts, retirement accounts can be used, investment accounts. You can also get help from family too, and we call those gift funds. Now, all assets in a real estate transaction have to be seasoned for at least 60 days, which basically means they have to live in your account for 60 days. But gift funds do not. So you can have a family member that can gift you funds right away, and they can be incorporated into your plan right away. Now, savings tends to be a challenge for a lot of our clients as I'm kind of building plans for them. And so in class, I always like to share back a really simple savings plan to help you maybe achieve your goals of homeownership and then kind of create a little bit of a budget for yourselves. And so the way we kind of position this is to, first of all, talk about like, where am I paying in rent right now, which is, in this case, we put a $1,500 rent budget. But after doing a consultation with me, let's say you're like, okay, I can afford $3,000 on a mortgage payment, right? So right now there's about a $1,500 delta in those two numbers. So if you could create a savings plan for yourself where on the first of the month, you make that $1,500 rent payment, but you create the discipline that another $1,500 goes right into your savings account, you're obviously building a nest egg in that savings account each month, of $1,500 surplus that's going in. And, by the end of 6 months, you got 9,000 in there. By the end of 12 months, it's 18,000. Not to mention, if you put it in a high yield account, getting 3% or 3.75, whatever it is on an annual basis, but it also helps you kind of prepare yourself from a budget perspective about getting into home ownership. Because most of our clients, when they take on home ownership, are going to be elevating the cost of their outgoing housing expense. And so, that's a great way of just preparing yourself, not only for the savings side of it, but just for the load of what that payment's going to look like for you in exploring home ownership. So I had a question that came in. I want to just read this off, and then we're going to go into the TSAC program. But should I sell stock 60 days in advance and transfer the money into a checking savings account before I start looking into financing? That's a great question. You don't need to do that. How we verify that is that you would show us the brokerage account, and obviously you have stocks that are in there. I would, depending on what the market conditions are and what your advisor advises you, you can still wait to sell those stocks until you're under contract with the seller. So it depends on how long the processing time period is. Usually it's a week to 2 weeks to procure the stock sale and make it to a cash transfer. That doesn't require a 60-day seasoning because we can source the assets from the stock account. Thanks for that question. Let's talk a little bit about first-time homebuyer programs in Texas, and I'll give you some kind of general national programs as well too. I think most of you guys were able to kind of chime in with your desired location, so that works out good. But ultimately, TSAHC, or the Texas State Home Affordable Program, is designed to help first-time homebuyers in the state of Texas with up to 5% in down payment assistance. And you have different options with the TSAHC program. There's variations to take it as a grant, as a deferred forgivable loan. The forgivable loan is forgiven after 3 years, which is awesome. So you can't refinance or sell the home within the first 3 years, but after that point, the assistance that you receive from the Texas State Affordable Program is completely forgiven. Now, the more assistance you take in programs like this, you're going to start to see higher interest rates. So if we can get just the baseline assistance of the minimal amount, generally we're going to have a lower interest rate start rate, which is really important. Now, if you're a first responder, military, teacher, you do have some extra incentives that are available with the TSAHC program. One of the things that I love about this program is it also includes the option to add on, when you participate in assistance, a mortgage credit certificate program. And that mortgage credit certificate can be up to 15% of your interest paid on an annual basis back to you in terms of a tax credit, which can basically help reduce down your tax liability for however long you keep the property. And that is allowed if you combine both the first mortgage with TSAHC and one of their assistance options. You can also participate in the mortgage credit certificate program. So that's a really great tool. Now, there are income limits for the program, so not everybody is eligible. If you're interested in that program, and whether you're interested or not, during a consultation, we'll explore different options, which will include that. And then, that's something we can kind of check out for you and see if there is that interest level for you. Nationally, there is the Freddie Mac Borrow Smart program, but it is designed for low-income housing buyers. You can get additional grants. Within American Pacific Mortgage, we also offer a national program called the Pathway DPA program. It is only offered on FHA loans, but it'll provide anywhere between 3.5% to 5% of your sales price in assistance. That would be more of a secondary product to, say, the TSAHC program, because the Pathway does not have income limit restrictions, whereas TSAHC does. So, we would first want to explore what that looks like for you under TSAHC. And then, if we still have that need and we're not meeting some of the criteria for that TSAHC program, then we would probably look alternatively at the Pathway program. And that's kind of part of what we do in our design process for you with your consultation. So it's a very interactive session that we're doing. And that really kind of leads us into our next and kind of more of one of our last topics tonight, which is just the buying process. And probably one of the biggest things to kind of understand, because I get that question quite frequently, is like, where do I go from here, Jason? I really want to buy a house, but I don't know where to go. Well, obviously it's helpful to come to a class like this where we can kind of put everything together for you. But then what happens after this, right? And so the next step after leaving tonight's class, we'd love to be able to get connected with you for that free consultation that you've heard me mention. It's a 30-minute virtual session where we just kind of design like a game plan for homeownership. Once we finish up that session, then the output of this is to be able to get you pre-approved, and you don't have to worry about a hard inquiry on your credit or anything like that. That pre-approval just kind of solidifies what our goals and objectives look like for homeownership, and it gives you like a letter that you can use to actively start shopping in the market. The pre-approval is good for 60 days, but it can always be recertified at any time. So we don't expect you to leave our session and run out and buy a house this weekend. It's just more so giving you kind of a start point of where to go with home ownership. So if it's a goal for this year, great. If it's a goal for next year, that works too. But we want to just make sure you understand really what your qualifications look like for home buying. Now, once you decide to kind of get on that path towards home ownership, you're going to start actively looking at homes, whether that's online, maybe some of you have already started that, whether that's in person working with a realtor, but that would take you to step 2 in the process. We'd encourage you to talk with a local realtor that's an expert in their market. We also have preferred realtors in the area that we can introduce you to after the pre-approval, but step 2 would be the next stage in the process. And I get the question often is like, well, how long is it going to take me to buy a house, right? And it really depends, because step 2 is probably the longest cycle of this process, because you may want to be in a particular school district for your family. You might want to be in a certain community because of lifestyle. You might want a certain home, and that might not be available in the market. So it could take you 2 weeks, 2 months, or maybe 2 years. But ultimately, the step 2 could be the longest cycle in the process. Now, when you eventually identify that home that you love and you want to make an offer on the house, that's where the realtor steps in and helps design the offer for you. And then they submit that offer to a seller, and the seller takes that into consideration to see if they're willing to accept your offer. Now, if that offer gets accepted, then now you are under contract to buy that home. And generally speaking, from step 3 all the way over here to step 6 to getting the keys to the house, it usually takes about 30 days. Sometimes it's 45 days, especially in Texas. Some transactions can be a little bit longer. Maybe the seller has to find their new property and they're just not ready to move yet, but they want to sell their home, right? So it just depends. But generally, from accepted offer to get your keys, it takes about 30 to 45 days. Now, once that contract is accepted, that kind of launches the lending into place. And I'll give you a call that day saying, congratulations, you have an accepted offer. Let's talk a little bit about next steps and schedule you for a follow-up video session. And that video session is where we meet for about 45 minutes just to go through the timelines of your transaction, what to expect, who's going to be contacting you, what your numbers look like, of course, discussing our disclosure process, all really important things so you feel completely informed as we launch into our process. Now, as part of your contract, especially in Texas, there are requirements for deposit, which our earnest money deposit counts towards your total out-of-pocket. It's usually 1 to 2% of your sales price, and it gets held with the title company while we start the process of buying the house. Also in Texas, there also are contingencies that allow you to do some due diligence on the property, whether that's an appraisal, inspections. We want to take a look at the title of the property, make sure there's no title issues, and of course, getting your loan approved. So that will generally all happen within the first 2 to 3 weeks, those contingency periods. And it's important because it protects your deposit while you're doing the investigative work. We'll continue to move down through the process. Step 4 is kind of more the administrative functions of the loan. We're doing a lot of the verifications, charting like where the assets are coming from the transaction, maybe getting your disclosures ready for some of the first-time buyer programs. And now we're preparing everything for the underwriting process. And an underwriter actually goes in and reviews your credit, your income, your assets to make sure everything is positioned correctly, and then issues the approval at step 5. And at step 5, we're also kind of nearing the finish line. Believe it or not, it's probably about 2 weeks into the process, maybe 3 weeks, depending on how fast things are going. You've gotten disclosures sent out to you to highlight all the things that we learned in our follow-up consultation. But I will say that when you're in the buying process, interest rates change daily. And so one of the things that we provide a value to our clients is we're always watching the market to try to time things as best as possible, because interest rates move during the financial trading day. And so there are windows of opportunity to lock a lower interest rate. So we'll kind of help you through that as part of your being a consultant for you during the process. Now, at step 5, we're going to give you your final closing disclosure, which gives you a 3-day cooling off period before we get to the very final milestone, and that's called closing the loan. So in Texas, it's called a table funding state. And what that means is we're going to draw your loan documents. We're going to wire the funds for your transaction. You're going to meet with the title officer all in the same day. And so that is part of the closing process. And the closing process takes about an hour or so with the title officer. Again, you're going to be wiring your final funds into the transaction. And then documents will get recorded on that day with the county recorder's office to note the file as closed. And once we get word of that closure of the transaction, now you're the official owner of the home. And it's a huge, huge, huge day of celebration. Super excited to be able to celebrate that with our clients. In fact, I made a couple calls on the way to the office today for people who are getting their keys today. And it's a huge deal. And we don't stop our relationship with our clients. That's what makes things us a little bit different than most. It's not a transaction for us, it's a relationship. And as you get settled in your house, we want to be always there as a partner for you on this journey. That includes giving you some great tools like your home bot tracking tool for home equity, rate watch notifications on when rates are changing and it makes sense to refinance your home. We haven't really talked much about that tonight, but providing you tools like that to make informed financial decisions, and then just checking in with you to see how things are going, at least on an annual basis. All right. So that's a little bit about how it looks in working with our team here. Now, if you're thinking about designing your home buying plan with us, we'd love to connect with you for that consultation. You can do so by going through our really simple get started process, complete an online application, you upload documents, and then you just use our scheduling system to schedule a call time that works good for you. And we do that all virtually. So, and we're in different time zones all across the country, so we can make things work that fits your needs. If you're just want to learn more and you just want to do maybe a follow-up call with me, we have our introductory call option. You can just hop on a schedule call and we'll just kind of talk through your scenario. Maybe you have some questions about assistance programs or maybe a credit situation, whatever it might be. Just love to be able to provide you any information I can assist you with. This is what our consultative process looks like. So it's very similar to all the key points that we hit on tonight, but it's just walking you through budget and location and resources just to make sure that you as a buyer have everything available at your disposal. We really embrace technology in our process too. So you can start this through mobile, but we are always available to we're always there for our clients basically. So it's a high touch experience for us. So we can start you through mobile, but whether that's a text to me or a call or email, we want to make sure we're here to help support you in whatever your need might be. As I close up tonight's class, we got a few minutes for some more questions if you guys have any. Just want to point out to you that we also provide a discount in our services, so a discount in closing costs. We always try to provide a really competitive option for you with whatever financing tool you're going to elect. And obviously you have access to classes like this throughout the year. If you've enjoyed tonight's class, love for you to be able to share that back with friends, family, and coworkers. You'll get the link to our recorded class, but we'll also have more live classes available throughout the year. And here's a list of some of our other partners that we have throughout the country. So it's been a pleasure hanging out with you guys tonight. Hopefully you got a few key things to take away. I would encourage you guys to check about in our communities, kind of what our community says about us, whether that's in our Reddit community, some of the testimonies we'll have in our Google reviews. You feel free to follow us on Instagram. We like to put a lot of great information out there. And of course, you'll be able to see tonight's class on our YouTube channel tomorrow morning. And finally, here's all my contact information. So feel free to reach out to me with any questions that you have after tonight's class or how I can best help support you on your journey. With that said, what questions do we have? I left about 10 minutes open for our discussion. I've already got a few questions that came in, but wanted to, if there's anything I can tackle. Okay, I got one. Okay, so question came in, which is if I plan to build a home, would you switch over to your company after the home is finished, or is that a thing? So I think what you're referring to is construction financing. So we actually offer construction financing within APM. So if you build a home, you're looking for financing to help construct the home. If you've acquired the land or not, we do have a construction team within APM that can support you to reach your goals there. So you would do a construction loan, depending on the construction timeline. Let's say it was 12 months, hypothetically. Then at the end of the construction, you can do a construction to perm financing where you're basically converting it to long-term financing, or you can do what we call a takeout, where you're just refinancing into more of a fixed long-term product. So yeah, we can help you kind of with the end-to-end solution there, depending on where you're at in your process. Thank you for that question. Yeah, I do see a lot more construction going on right now. Buyers are taking on construction. Obviously cost of construction is not cheap, but we do have instruments that we can help you with that. All right, any other questions? I got one more that came in. Okay, and then question came in, which is, could you please discuss why it might be better to go with a 30-year home loan versus a 15 or vice versa? Yeah, we get that question a lot. I mean, I will say most clients are doing 30-year fixed mortgages because you're obviously spreading that loan over 30 years versus 15 years. And so It's just a function of affordability. But the trade-off is a 30-year fixed mortgage can tend to be about 0.25%, maybe to 0.5% higher than a 15-year fixed mortgage. So if a rate was 6.5 on a 30-year today, it's probably 6% on a 15-year. So, it really just depends. I think it really comes down to budget. And, when you're going into that 15-year product, you are going to see a pretty significant jump up in monthly payment. Now, there's also in between points. You can do 20-year loans, you can do 25 years, of course, 30-year loans. So you don't have to be necessarily locked into just either a 30 or a 15. All right, thanks for that question. And right now, I will say, because if you look at short-term and long-term rates in the financial market space, there's not a huge difference between like the 2-year and the 10-year. So, the other question I get is, well, is an adjustable rate mortgage better for me than a 30-year fixed mortgage? I'm not a huge fan of doing adjustable rates right now because I just don't think there's enough upside in it. And especially as first-time buyers, I really would prefer for you guys to have something that's a little more locked in long-term, because adjustable rates will adjust at some point, whether that's a 3-year adjustment, 5, 7, or 10. And you just don't want to feel like you're on the clock to have to make a refinance move because your payment's going to go up after the end of that short-term period. Because on adjustable rate, yeah, you're going to get a slightly lower rate, but then it's going to force you to do something in some period of time. So, 30-year fixed generally for most first-time buyers is going to make the most sense, especially with where today's market's at. Any questions on, I like to throw this out. I sometimes get questions on multifamily purchases. So if you're purchasing a rental property, do you guys have any questions around that you want me to share back with you guys? Feel free to ask any questions there, because I do, get questions of doing the quote unquote house hack of trying to be able to rent out a couple units and then living in the primary. Essentially, when you buy an investment property, let's say it's a multi-unit property, the minimum down payment to purchase on investment property is 5% of the purchase price for a conventional loan. It's 3.5% for an FHA loan. Most first-time buyer programs will not be compatible with a multifamily purchase. You usually have to buy like a 1-unit property, single family home, condo, townhouse, that kind of thing. But when you buy a multifamily, so let's say I'm buying a 3-unit property and I'm going to rent out one of those rooms, or both rooms, I should say, units for $1,500 a piece, we can generally take a portion of those rents to help you with your qualifying. Usually they'll use 75% of the rents that can count towards your qualifying income for your home purchase. So if you have a 3-unit property in Dallas that you can buy for $750, if the math works and you can rent out those 2 units for X amount of dollars plus your income, that could potentially help you qualify for say a triplex or 3-unit at that $750 mark. Okay. Let's see, anything else? Okay. Any other questions? I know everybody's hanging in there, so I'm ready to go if you guys got questions that I can help answer. If not, we are going to get you obviously this recorded class. Okay, question came in from James, which is, do you typically see interest rates change depending on if the home is a new build or older? No, I mean, interest rates will not change whether regardless of the age of the property. So yeah, so that won't have any effect at all. What will have effect on interest rates is your down payment, your credit score, and how much you finance. What we also didn't talk about is the type of property can influence it. Like if you're looking at a condominium versus say a single family residence, that could change it or create a variation in your interest rate offering. So every lender has what they call is loan level price adjustments that are set forth by Fannie Mae that basically give us the directive of how much the cost is going to be based upon the risk for that particular product. So it's condos, the loan to value, or how much you put down, what your credit score is, that kind of stuff. And so that's why I think also why a consultation is really important, because I think it's important to be strategic in your down payment. And there's different down payment levels that influence interest rates and mortgage insurance. So those down payment levels go 3%, 5%, 10, 15, 20% down. And then of course, 20% down, I have no mortgage insurance. But then on the other side, from a pricing standpoint, 25% down and 30% down will be the least amount of expense to interest rate. Yeah. Question about the new housing bill that's going through Congress. I actually have not had enough time to dissect that or digest it, I should say. I can share that back with you, go. I should have actually kind of done some research. I didn't have time for tonight's class, but I can take a look at that and report back to you guys. I got a question for the group. It's just the new housing bill that's pending in Congress right now. So I will report back to you guys. I don't want to really comment on anything I don't really have a common knowledge of yet, but I know there's some talk around that. I need to see the details of it and see how fast. I heard it could get passed as early as this week or Thursday, I think it was what I heard, but I don't know all the details of it, so I'll have to report back. And we'll give you some commentary on that when we share back the presentation material because you guys get all the slides and like I said, all the recorded version. So right. All right. I just want to make sure I didn't miss anybody here. You're very welcome. Thank you so much. All right. I think we're good, class. Thank you so much for being a part of tonight's session.